On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. Before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners financial advice provider disclosure statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. It's been a sluggish start to 2026 for the US share market. The S&P 500 index is up slightly, but it's still well behind the UK, Europe, Japan, and emerging markets. It's also been quite volatile of late, and it's fallen for 5 out of the past 8 weeks. It does feel like we could be in for another bumpy year, and we might even see a bigger sell-off in the months ahead. Now, that's not something to be afraid of, and it doesn't mean that the market still can't put in another solid performance on an annual basis. Intra-year share market drawdowns, and that is financial jargon for declines from a recent peak. Those intra-year share market drawdowns are not uncommon. In fact, a fall of at least 5% at some point during any given year is actually quite likely. If we look back to 1950, and the 76 calendar years since then, I'm including 1950 in that, the S&P 500 index has slipped by that magnitude from a recent peak 7 out of 10 times. 5% down, 7 out of 10 times. We've seen double-digit drawdowns roughly every second year, and the average decline for all of those years from 1950 to today is 12.1%. Now, while the reasons behind those falls are always different, the declines like that are par for the course. Last year it was tariffs. This year it could be tariffs again, actually, or it could be something completely different. Who knows? Or it could be nothing at all. Since 1950, US shares have delivered positive returns in 60 out of 76 years. So that's a very good hit rate. Almost 80% of the time, the market has been up. But even in those years, even in those 60 up years out of those 76, the average decline or drawdown was still 8.7%. So you still get that weakness quite often, even in a good year where things turn out to be up. Things can be even more challenging during midterm election years, like this one. The US midterm elections are held every 4 years, so it's alternate to the presidential elections. Had a presidential election in 2024, so you've got a midterm election in 2026. There have been 19 of those since 1950. They're actually on the same schedule as the Football World Cup. One of those coming up in a few months' time as well. So in those 19 years where we've had US midterm elections, 12 of them have turned out to be up years. So that's a more modest hit rate than for all years. Remember, for all years, it's sort of 4 out of 5 years. In midterm election years, rather than being 80%, it's about 63%. So still most of the time you're up, but there is a greater chance of it being a down year or it being a volatile year. Average returns are slightly lower during those US midterm election years too, and the average drawdown is higher at 15.6%. Now that is all understandable because the threat of potential policy change always can lead to nervousness and uncertainty. There is more than 8 months to go until the midterms. They take place in November, which is very close to our own election, isn't it, here in Aotearoa. All 435 seats in the US House of Representatives will be contested in the midterms, and a third of the seats in the Senate, 35 out of 100, will be contested. Now, typically, the President's Party usually loses seats in both the House and the Senate in the midterm elections. That's the normal course of action. And that negative effect is usually more pronounced in the House because all of the seats are up for grabs. And in the Senate, it's only 35 out of 100. So right now, Trump's party, which is the Republicans, they currently control both the House and the Senate. And most people are picking them to lose control of the House by the end of this year after those midterm elections. So I guess what we need to think about and acknowledge and understand is that volatility is the rule rather than the exception. It's not unusual for markets to have these ups and downs along the way, even in years that turn out to be pretty good. Midterm election years often can be even more volatile. So just be aware of that and prepare yourself and make peace with that. That is normal. Financial markets have still historically performed very well in spite of this. Over those almost 8 decades that we've looked at, the 76 years back to 1950 and including 1950, almost 8 decades, and the S&P 500, and I'm including dividends that have been reinvested in this rather than dividends that were spent, because dividends are a part of your return, so we need to include those. The S&P 500, including dividends, has delivered an annual return for that whole period of 11%, which is pretty good, isn't it? But here is the catch. You don't get that good return without living through the ups and downs, and those ups and downs come very regularly. That's all for today, team. Thanks for listening. We'll talk again soon.
For more insights, visit craigsip.com.